Well, welcome everybody to our December investing topics. Ken Kavula and I are here to rock the house. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and I'm joined here by my colleague Ken Kavula. Say hello, Ken.
Hello, how is everybody?
And we actually have some pretty cool stuff to talk about tonight. This is going to be another one of those sessions where we're going to scratch our heads together, along with the night in the middle, and figure out who's the smartest of the three. And sometimes the night wins, but it's just one of those things. We've been wrestling about this. It's a topic I have been kind of enthralled by for the last calendar year or so. And I think tonight's presentation will actually give some foundations or some reasons. You'll be able to see some of the reasons I have been kind of fascinated by this topic of return on owner's capital. And let's have some fun. By the way, that's a Smithsonian photograph of the schoolhouse in Grayling, Michigan, which is part of the Mid-Michigan chapter. So we got to stop by that someday, Ken.
Yeah, I'll go there before I go to Puxatawny, Mark. It's a lot closer
I,
drive,
I
okay?
think it's on the way. I think it just might be on the way. All right. Everybody knows the drill, but no investment recommendation is intended. We are going to be talking about some current data on some real stocks, real companies tonight. The stuff that we do here is for illustration only. It's all about education and demonstration. That's kind of our hallmark at the Mid Michigan chapter and Manifest Investing. That's what we try to do. And we might own a few of these that we talk about. We'll try to disclose that, but please do your own homework. And if you want, you or a friend or a family member would like to be reminded about these events, we hold monthly webcasts called the Roundtable. We hold these about every other month or so, seizing on an investing or an educational topic and an opportunity to perhaps kick around some lessons. If you want a reminder about that, please send an email to nkavula1@comcast.net. We generally do green rooms and we do some follow-on extended Q&A period after many of these type of presentations. If you have a question or a follow-up to that, or if you would like copies of the slides, please send me an email, markr@manifestinvesting.com. And I am winning the battle against the inbox after Thanksgiving. Should be back to normal here pretty soon. All right, Ken, are you ready to dig into this one?
I sure am, Mark. It's return on capital, and we're going to talk a little bit about how it drives stock price. We're going to talk a little bit about how to calculate it or about our flavor of calculating return on capital. We're going to spend a lot of time on what exactly it is with some nice concrete, down-to-earth examples. And then we're going to show how it might be used to help you decide whether or not an SSG is in the ballpark or way outside the fence somewhere. For a lot of the folks that we've been reading in the last couple of months, we're getting the idea that this idea of return on capital is one of the things that should be on everybody's list of ratios that they use on a fairly regular basis. The problem is that it's a ratio that doesn't have a real standard definition to it, and some of the ideas in the ratio, while they're pretty straightforward, can be a little bit daunting to pull off of a set of financial reports. You can use it to evaluate everything from a local business idea to a large cap tech stocks. Return on capital, as it's called, or return on invested capital, as it's sometimes called, ROIC, as it's sometimes called, is referred to as the single most important metric in gauging a business quality. And you can see the quote from the Wall Street Journal and the quote from Warren Buffett. So what is it? Well, it's the most simple of terms. It's profits divided by investment in the enterprise. ROC or ROIC shows how much money that a business can conceivably make for every dollar that it puts to work. The profits based on invested capital. And let's drive that home with a real simple explanation. I think it's on the next slide, Mark, isn't it? Hmm.
Yeah, just a quick summary, just to point out that it is again, there are different flavors, much like in some cases PE ratios have different flavors and some different interpretations, and we're going to take advantage of that flexibility to 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 basically build on the foundations of the modern investment club movement, and use a stock selection guide to drive this process. I will mention that Ken and I were out in Puget at Seattle at an investor conference not long ago, and we mentioned that we were going to be doing this, and I received 3 or 4 notes from people, including one of the professional investors that was in attendance, and he basically said, "Tally ho!" He uses it all the time. He's got an approach for screening and that sort of stuff, and that is some of the stuff that we want to talk about. So again, it's very much like a lot of the things that we do, only we're going to pay some concrete attention to debt and the cost of debt in combination with equity as we do this. So, as Ken was
I do
saying, go ahead,
Go on,
Ken.
Mark. Yeah. I do think that one of the most challenging things when you're talking about this particular topic is the fact that there's no standardized vocabulary when you start moving into a lot of the accounting procedures, or you start moving into many of the financial ratios. And so, you end up talking about the same words meaning different things and different words meaning the same things. And it can become a little bit confusing when you first walk through the whole thing, even though the concept itself is fairly straightforward and fairly easy to understand. It's defined as nothing more than profits over capital employed. But I read a paragraph in one of our sources, and we'll have a source list for you at the end of the evening. I read a paragraph in one of our sources that alluded to the fact that calculating return on capital could be as much of an art as it is a science. And by that I mean determining the capital being employed is not always the easiest thing to determine by just sitting and looking at financial statements in an annual report. A lot of value judgments have to be made, and many times the definitions are just different enough that they yield different results without you understanding that they're really talking about the same thing. A number of 10.7 versus a number of 9.8 for responses really end up being the same kind of value. It's much the same way that we know that when we're looking at value line, there are many different ways that value line calculates a PE ratio. Sometimes on that one single-sided sheet, they're using 2 or 3 different kinds of PE ratios. I know that we use forward PE ratios as well as trailing PE ratios on the SSG. I know on the stock comparison guide, we use variance, which really are PE ratios, but they're PE ratios using longer terms than we're used to seeing, or shorter terms. So all these things put together, flavors, but they're all the same ice cream when you dig down and look at the recipe.
Yeah, and
Here's a really good, go on, Mark.
I'm just going to reinforce what you had to say there. I mean, it is amazing when you go into and just Google the different terms. There's even, there's an ROCE, return on capital employed. I did, after we got off the phone earlier today, did find ROC in a number of places, so it is out there, Ken.
Good, good.
But I think the point I want to launch the discussion with is we work towards simplicity. It's like gravity to us. And as an engineer, I really like the simplicity of what you're about to see, everybody. I do think this is a solid approach to thinking about this topic. So, Ken, why don't you launch the quick example?
Well, let's start with an example that should give you an intuitive feeling for what return on invested capital or return on capital really means. Imagine a friend came to you and said, let's ask you to put some money into a restaurant. And he tells you that the restaurant earns $200,000 a year and $50,000 of that is annual profit. And the question is, would you do it? Well, you think to yourself, $50,000, $200,000. Well, that's a quick 25% profit. That's a pretty decent profit. But it's a trick question.
Well,
You
my answer is
actually
no.
need more information.
My answer
Well,
is
that's
no.
because you know the answer, Mark.
No, I don't want to own a restaurant.
Oh, all right.
It's really hard
What,
work.
yeah. What's being left out of the calculation is how much is the person really asking you to invest in the restaurant? What are the dollars that you have to put in to generate those dollars that are coming out on the profit end? In other words, how much capital is the person asking you to stand in order to get that $50,000 in annual profits? If that person's asking you to invest $1 million to buy and set up the restaurant's building and the ovens and the furniture and the staff and the front of the house and the back of the house and everything else that goes into a restaurant, then it wouldn't be quite the compelling business that you originally might think it is. You'd be only making 5%, $50,000 on your $1 million investment every year. And there's a lot of easier ways for me to make 5% on my money than to put all of my time and all of my effort into trying to get a bunch of folks to eat at my restaurant often enough for me to generate a profit. Well, this is what we're trying to capture when we're calculating return on capital. We're not measuring profit on sales, profit on revenue. We're measuring profit on investment, profit on the entire amount of money that you've put at risk. And I think Mark can put that into a mathematical formula fairly easily. Mark?
Yeah, and I was just going to say, for 5%, I'm just going to buy some forever stamps. Just fill a room full of them. And
All right.
all right. Well, here we're going to lean on the work of Joel Greenblatt. Ken likes restaurants. I like real estate. I really understand this. And Joel Greenblatt has a tremendous record in investing. He's a educator. He's a professor at Columbia. He wrote a book, You Can Be a Stock Market Genius. Some of you in the audience have read it, probably digested it. So this is turf that you've been over. And what it's got to do with is just that same thing. You buy something. You decide how much it's going to be worth by, what will be worth in the future. Not only that, but what can I make in terms of perhaps it's a rental property and the amount that you could get for rent. And what if you were told, yeah, this $100,000 house that you're paying cash for is going to give you $1,000 a month? Is it a good deal? And you can generally get your arms around that pretty quickly. 12 times they pay the rent on time, $1,000, that's $12,000 a year. You're basically talking about a 12% per year return. Now that starts to get our attention a bit. If we assume that the meager rate of appreciation in real estate in the Midwest, 3 or 4%, offsets the expenses, that would actually be the amount that you would be netting on this type of an investment. Obviously, there's a lot more to it, but this is the type of thought process that we go through. What type of cash flow or money back into my pocket am I going to get out of this situation? 12% sure seems to beat 5% all the time. He did write a follow-up book, by the way, the little book that still beats the market, where he talks about this magic formula in greater detail. So let's go ahead and take this away and put it in terms of the modern investment club movement. I'll take the first one, Ken, I guess, and just point out we're talking about return on owner's capital. We're abbreviating it ROC, but we want to emphasize this notion of becoming an owner and thinking like an owner, perhaps even to the point of hypothetically thinking of buying the entire business. And, Ken was talking about that jargon thing. As we got started, return is the same as income, is the same as profits. You wonder why people have trouble getting started in, students and individual investors that are trying to find their way. This is part of the problem. Those are all the same word, the same thing, 3 different ways and in many different flavors. But Again, we're talking about the income over the capital. In this case, the capital is fairly conventionally referred to by people like Greenblatt and others. That's the enterprise value, and it really is the equity in the business plus the debt on the denominator there. So again, let's put things in terms of, we'll start with, profit. What type of profit do we want to talk about? I would like to propose that we use a stock selection guide output, something that we do along the way as we study any company. If we figure out the pre-tax profit, the Section 2A type stuff, and we look at a 5-year projection. And again, because I want to center in on that preferred procedure, we called it the preferred procedure because it was preferred. And it really comes down to understanding that top line growth, the trajectory, the pattern that's taking shape, and really focusing in on the profitability and sticking to that pretty well. So again, for the numerator in this equation, again, taking us back to one of the first stock selection guides published in Better Investing magazine, which was, by the way, referred to as the NAIC Bulletin in the early days. And the company here, this was prepared by Ralph Seeger, by the way, the company here would happen to be Lilly Tulip Cup. And in the early days of the stock selection guide, you plotted the sales and you plotted the pre-tax earnings. That's right. The earnings were not on the front side of the stock selection guide. Section 2A was on the front side. And it was that way for quite a while. And again, the reason we bring it up is this really was preferred. So again, focusing on what that top line is, where would it come from for any company? We're going to go ahead and start with TJ Maxx. Ken, would you like to kind of walk through gleaning the pre-tax profit right off of the workings of a completed stock selection guide on TJ Maxx, TJX companies?
Keep me honest, Mark. We haven't practiced this a whole lot, so keep me honest.
We do this all the time.
We're gonna start with the visual analysis, and you all know green line sales, pink line pre-tax profit, blue line earnings per share. And we're going to look at the pre-tax profit 5-year projected. Well, if I'm doing my SSG correctly, and this is a screen capture directly off the SSG Plus, I can hover over that kind of a diamond shape at the very end, at the extreme right after the dotted portion. I can hover over that diamond, and that represents the pre-tax profit 5 years into the future. And I can also see it in the actual numbers down there on the bottom. And that pre-tax profit is a number that I can pull off and use for the numerator. Stock price, obviously, as current as you can get it, minus cash per share. And in this case, I'm going to have to go somewhere to a 10Q or a 10K. That's a quarterly report or an annual report. Or I can go to the Better Investing data for the company, and I can find out how much cash per share is being carried in the financial statements. I'm going to add to that long-term debt per share, and that's where that 605 comes from. Now let's see if we can actually pull the numbers. If I'm looking at that second line down there at the bottom underneath the visual, there's that $4.78 numerator. That's where the historical earnings per share are going to end up being. The stock price,
well, we'll get that in the next slide. We're just
okay.
focusing on.
All right, I'm going to leave that then. Okay. Yeah.
Yeah.
And I'm going to divide that by. I'm going to divide that by 1 minus the 21% effective tax rate. I'm sorry, the 21% expense ratio, and that gives me how much of the earnings are left for the to use in the calculation. I messed that up pretty well, Mark. Why don't you walk through that again, okay?
Well, no, we're just simply taking the bottom line, which is earnings per share, and backing out the taxes. And so you're basically at the point where, on the right hand side of this, and then somewhere out in here would be $6.05 for the pre-tax profits. Interestingly enough, if by the way, Susie Artsberger gets lots of credit on this one. You can actually get there the same way by taking the net income or the pre-tax profit from 2018 and growing it out for 5 years, dividing by the number of shares, you end up at $6. So we're talking about $6 of pre-tax profit 5 years out. So I'll keep rolling with this one a little bit because this is one that actually threw the audience a couple of months ago when we first talked about this, and they wondered why we were subtracting out the cash. So I wanted to spend a moment on it. And the message is think like an owner. There's a story that I've told many times about paying $50 for a coat at a garage sale and then finding a $20 bill in the pocket. Well, you now own the coat, you've walked away. How much did you really pay for the coat? And obviously, it's that original purchase price, subtract out the 20, and you really only paid 30. Now, the story is actually better than that. It has to do with my grandmother helping us at a garage sale where we were selling one of my old coats for $10 with a $50 bill in the pocket that I had forgotten about. So she obviously wanted to buy every coat that I was selling. And the rest of that story is down below at that Expecting Alpha address. But again, just this notion of once you buy it, you own it. And if that cash is in the account, as an owner, you could do whatever you want with it, much like buying that house. So how much cash does TJX have? The answer is just over $2 billion, 2008 million. And with a little over 1,100 million shares outstanding, we're basically talking about $1.80 per share. So we correct the equity part of this equation, basically take the $59.80, which was today's stock price, and subtract out that $1.80. Because we could do whatever we want with that $1.80. We could use it to pay debt. We could pay a special dividend. So the adjusted price for today would be 58. So that'll go with our $6.05 and be part of the equation. Now on the long-term debt, and again, it's per share. Again, thinking like an owner, thinking mortgage. How much long-term debt do they have? In this case, they've got 2232. It's basically 2.2 billion or 2,232 million. And again, with those same number of shares outstanding, correcting it to dollars per share to put it in context and make it fit the formula, we're basically talking about the math that's shown there, $2 per share. And who doesn't like to celebrate mortgages and Mr. Potter along with George Bailey at this time of year? You might even say that's wonderful, Ken.
That's wonderful, Mark. I am going to suggest a revision already, and since this is a work in progress, as we move through these slides, folks, we're going to also talk to each other and do some slight revisions. I would suggest that maybe this formula makes a little bit more sense to me if the numerator says pre-tax profit 5-year projected per share, because then it matches the rest of the formula.
Okay, makes sense to me. We can clean that up a little bit just to remove any doubt, because we do want everything here to be per share, just like the stock price.
Right, and we took the time to put cash per share and long-term debt per share. So I think that would make it very clear as to where we're getting that pre-tax profit from then.
Okay, I'm going to come back to that Ulta Beauty in a second because Ken has an editorial comment to go into. But again, just to finish out the math. And again, it's a matter of the income divided by the capital, and that's really the enterprise value on the bottom there. The $6.05 is divided by the stock price minus the cash in the pocket, and we add in the debt capital at $2 per share, and you basically end up with a 10.1% return on capital. Okay? And again, the thing that we're going to explore here in a second is, how does that number relate to something that we might be able to sink our teeth into? Again, using that pre-tax profit divided by the enterprise value, that 10%. Now comparing it against a traditional equity analysis down at the bottom, you can see that we have a situation where we've got a $40 billion company growing at about 7%. Again, this matches up with Ken's SSG. So again, a $58 billion company 5 years out All of the numbers in this column are 5 years out, as shown here by the date. Okay, so we're basically trying to build this image of what the company will look like 5 years out. A little bit higher net margin at 9%. Again, that's analyst consensus driven. A little bit of a share repurchase program, but we're talking about $4.88, again, matching the stock selection guide. Going with a PE of 17 generates a situation, slight dividend, where we're talking about, let's call it 9%. So 9% actually reconciles fairly well with 10% in our world, and actually begs the question, is it going to be that close most of the time? And we'll come back to that because Ken wants to share some thoughts about some changes that are currently happening that we just want to make sure that we hold our finger up to the wind. And
before we move into that, Mark, let's clear up a few immediate questions that are coming, because I know sometimes when you ask a question, it stays on your mind and you're not catching what's coming until the question is answered. First of all this stuff, thank you everybody for all of your answers about Schwab and TD Ameritrade. And the end result is that it will be about a 1-to-1 trade. In fact, TD Ameritrade shareholders are going to get 1.08 shares of Schwab. It's an all-stock deal, no cash involved, okay? Ron from California wants to know, is return on invested capital available on the SSG? Ron, no, and in fact the point that we've been making is that so many of the people that we respect as investors are telling us this is one of the most important metrics that we should be considering on our way to evaluating a stock, but it takes a little bit of extra work to actually pull the numbers together to calculate it. We're showing you one particular flavor of return on capital, ROC, and we're suggesting that we're looking for the most simple calculation that we can come up with. Again, we're doing the SSG and a lot of the calculation with crayons rather than with number 2 pencils. And so we're looking for simplicity, and that will answer George's question also. George wants to know, couldn't we make this a lot more complicated by considering interest expenses and a few other things? And the answer is yes, absolutely, George. We could make this calculation much more complicated. And in fact, if you do some homework on this, you'll notice that many folks take a lot more time to pull some of these values together, but they get basically the same numbers that we're generating here as an answer. So what we're basically saying is, let's try it this way, a relatively simple calculation, something that we can pull from just a little bit of simple research on the research pages in Value Line or even in the Better Investing data page, and we can use that number, and that's what we hope to show by the time the evening's over, what we can use that number from. One more question from Mary from the Cleveland area, and Mary says, well, what about buybacks that dilute shares and all that kind of stuff? Mary, this number, like so many numbers that we deal with in Better Investing, is a snapshot in time. And if the number of shares change drastically, then this number will also change, but it'll be a snapshot in a different time period. And we're going to do as good as we can at the time when the calculation is being made. And then if we have to revise that calculation in 3 months or in 6 months or in a year, then we'll be willing to do that. And again, it doesn't take that much time to pull this set of numbers together. We're not going to try, however, to use this calculation over long periods, but rather we're going to say to ourselves, you know, it's simple enough that every quarter, if I have to recalculate this, I'm willing to recalculate it. And I think Mark is going to be eager to maybe make this a number that we can come up with fairly easily using some of the data that is in his website that'll help us pull some of this together pretty quickly.
Pretty
right,
much
Mark?
on that. And yeah, and Yeah, the other thing is, Mary's making a good point. In this column right here, you can see that the assumption, in this case made by the value line analyst, is that this company is going to be taking 85 million shares off the table. Um, the effect of that happening has actually already increased this number. So if that were not to happen, if you went back basically and put in a higher number here, it would affect the earnings per share, which would affect the 605 up at the top, right? Because that would affect it. So you could look at the impact of a buyback situation. The other thing that I think is so cool, and I don't want to get too tripped up in this, is this formula as it's laid out right here. Basically, is a decision tool. What if you took this $1.80 and you paid off the debt and basically made that go away? This number up here goes up because your interest expense went down. So you could literally see, well, what if I decide to do that? What does this, where does this number go? Does it go to 12%? Question mark. I don't know what the number is. Whatever the number is. So you could do like a what if almost as a decision type tool. So you can do some of the things that these people are asking about. And we're gonna have some fun with this, Ken.
And the final question that I want to clear before I go to the value line sheet, Mark, is from Jane in Western Michigan. And Jane says, now she missed it. Where does this number go on the SSG? Jane, you didn't miss anything. We just haven't been able to get there quite yet. So hold on to your horses, and we'll be showing you how we think there's a practical use for this number. I'm seeing it as extremely practical. Maybe you won't see it in the same way, but that's what makes a discussion. Let's go back to that value line page now, Mark, and talk about something that's coming, and just give a little bit of flavor and to what is on the way, and then to steer people to the Ticker Talk program, which is going to be on Thursday. We're on this coming Thursday, December 7th, I think. December 5th, I'm sorry. We're going to have Ticker Talk. If you haven't registered for it and want to be there, please go to the new website and look for Ticker Talk and register. We're going to have Cliff Trent, the comptroller for the association, on Ticker Talk, and he's going to be talking about a new situation that we're going to have to be aware of, and it plays into this return on capital because it involves debt. We're going to have to become very aware that starting at the first of this year, back in January 1st, actually it started on December 15th of 2018, going back that far, companies are now beginning to report uncapitalized leases as debt numbers. So we're going to start to see companies that we're kind of used to seeing with zero debt, carrying zero long-term debt of any kind. Ulta Beauty is a prime example. If you've owned Ulta for the last 5 or 6 years, you know that line 3 on the analyzing management section has said zero debt. Well, starting with this fiscal year, the 2019 fiscal year, we're suddenly going to start to see significant debt with Ulta because of all the uncapitalized leases that it carries for almost every single store in the entire chain. It's a change in the way that companies are reporting to the SEC, and of course that means that it will change with our data as well. Cliff does a really nice job. We were in practice today getting ready for the Ticker Talk on Thursday. And if this interests you, this big change in the debt number for many of the companies that you're going to follow, if this interests you, I would urge you to come to Ticker Talk on Thursday and get an overview of why the change is happening and then how it's going to impact our SSGs going forward. I'll give you one great big hint. We think with a little bit of calmness and with a little bit of thought, it won't be nearly as disruptive as you might first think when you let it kind of run around in your mind. So we hope to see some of you there and get some real good questions out of that. You're going to start to see on these value line sheets, Mark's put a red box around the uncapitalized leases that have started to appear now as of the first and second quarter of this fiscal year. And you can see them right there. That number is going to move to the financial statements as debt, as long-term debt. And you'll notice that, and again, he's highlighted the long-term debt line in the array, and you'll notice that up until this time, that line has had little dots, has had zeros in it. The estimates have been nil. Well, those estimates of nil are no longer going to be valid because the mandate has come down from the accounting people that they're going to have to consider uncapitalized leases as debt. That's about all I want to tease on that right now, Mark, but it will be a good ticker talk, and it'll be a topic that we're going to be talking about for the next probably 9 to 15 months as we move gradually into this idea, and as we see companies that we're not used to seeing carrying debt suddenly carrying a fair amount of debt.
Yeah, and I will just add that, again, remain calm, own it, remain calm. Ken and I talked about this afternoon, so I went through and looked at a handful of retailers that are going to be impacted in similar fashion, and it actually doesn't do that much impact to the return on capital calculation. Most of the companies went from numbers like 13 to numbers like 12. Even in a worst case situation here for Ulta, if all the total long-term liabilities of $547 million are considered long-term debt, it doesn't make that big of a difference. Not a material or a significant difference, but it is going to be a pretty good change. Note that they do have $327 million in the checkbook. All right, so with that, it's time for a little bit of a headache. We'll try not to be too bad of a headache here, but all I've done here is a comparison. I took the 900 value line industrials. We left out the asset-based companies like banks and insurance companies and looked at just the industrials. And on the x-axis, we plotted the par for every company versus on the y-axis, the return on capital. All right, so it literally is just a comparison of one versus the other. If they matched, it would be a point like at 15-15 or 30-30, if they were exactly the same. And, that basically that red line running up the middle is the trend. And if it was perfect and if they were matching all the time, it would basically go from the lower left at 0-0 up to the upper part at 30-30 at a 45-degree angle. What you see here is actually kind of cool because it's a scatter chart, but it's not that scattered, and it actually looks fairly tight considering there's a wide variety of companies. Keep in mind that there's a bunch of smaller companies in here. There's many of the energy companies, biotechs, things like that are a little bit tougher to do a return on capital calculation, so they were left in there. I do find it interesting that the average return on capital for this subset of companies, again, approximately 900, is 9.8%. The average projected annual return is 9.1. And again, what I'm looking for, again, is context. Do the two numbers compare to each other? Is it something that we can use as kind of an audit? That's what we're going to talk about here in the second half of the program. So again, looking at any one of those dots, the distance off of the red line, either high or to the high side or to the low sides, means that there is a disparity. Again, if it's closer to the red line, they're basically more in agreement. Anything you want to add to that, Ken?
Yeah, I want to move people's heads to the place where they're not thinking that they have to go back and recreate all of this arithmetic that we're talking about right now. We're trying to give context. We're trying to give gravitas to some of the concepts that we're talking about right now. But you're going to have the luxury of finding somebody else that can calculate some of these things for you. And we're going to ask you at some point then to use the two numbers. That will be the important part when it's all said and done. It won't be the calculating of the number. We can find machines and databases that will calculate the numbers for us. It will be how do you use those numbers. And the key takeaway from this picture right here is that the average return on capital matches the average par value pretty darn closely. But the two numbers for my use, drawing with crayons on an SSG, those two numbers are the same numbers as far as I'm concerned.
But wait, it gets even better. Let's talk community favorites. And we've seen this with a number of characteristics and things that we talk about. We don't have to own or buy every company in the value line 1700 or the value line 6000 or whatever the number is. When you start talking about companies that we basically deem to be excellent or core community favorites, they could be in the Manifest 40. There could be roundtable companies, companies that we talk about on a fairly regular basis, and yes, in most cases own. It actually gets even better. And you notice that the line actually does now run pretty much up at a 45-degree angle up the middle of that graphic. And that's actually a fairly tight distribution. And again, the average return on capital at 10.2 versus the average par for, again, this, let's call it a vetted, Ken likes that word, vetted list of companies that we follow and own. And, the one that's got a little bit of a variance there would be Five Below. Five Below, for whatever reason, has a par of approximately 20% and a return on capital of somewhere around 10%. So we're going to dig into that one as a case study and take a little bit closer look. Anything else on this one, Ken?
And again, I want to point out where that par value is coming from. This is not somebody's pulling numbers out of space. This is a par based on the analyst consensus numbers. So the analysts are telling us that they have a potential annualized value going forward for the next 5 years of around 20%, just a little bit under 20%. If we calculate the return on capital for Five Below, we see that it's only 10%. And the question is, why is there such a disparity between those two numbers for this particular company when, on average, the return on capital and the par values are essentially on top of each other?
So let's take a closer look. And before we jump into five, here's a list of some of those quote unquote community favorites from top to bottom. They're actually arranged from the companies that have a lower par compared to the return on capital down to the last one, Five Below, which is what we're going to take a look at. Higher projected annual return versus the return on capital. But, drawing your attention to those names, right down the middle, many companies that are amongst our community favorites, many of those companies are in your portfolios. And notice that the numbers pretty much lay on top of each other a lot of the time. So again, what we are exploring and seeking, part of my infatuation of the last calendar year has been that could this be a really nice potential audit situation for checking results? So let's talk Five Below. It's the one at the bottom of that list. This is kind of a worst case situation. Again, you see the return on capital, the income versus the capital. The numbers are there. The 1094 is the pre-tax profit based on a stock selection guide for Five Below, 1094. The current stock price is $116.02. I believe that's tonight's close. They have a little bit of cash in the bank. It amounts to $4.67 a share, so we correct for that. And they do have a little bit of debt. That might be coming from a lease obligation. I don't remember off the top of my head, but a little bit
They
of
are
debt.
coming from lease obligations. All of it is, yes.
So I stuck that in there to see, Worst case situation, reflect that lease obligation as long-term debt, and we end up with that return that you saw on the previous page, return on capital somewhere in that 9% range. Now you compare it to a stock selection guide, again, as Ken was saying, the analyst consensus is largely driving this. We're talking about a $2 billion company growing at about 20% a year, which you see here, generating net margins somewhere in the 10% range, and rocking it home at a par of like 34. And this is where the analyst consensus gets a little bit frothy. That's an average par or PE,
Not
excuse me.
our PE value. Yeah.
Right. So, we're talking about a high PE of, let's say, 42 and a low of 26 on your stock selection guide. That's getting to be a little bit, but, not crazy. It's not madness. And that's how you get to that projected annual return down below of somewhere in that high teens or 20% realm. Not science fiction, but is it possible? Is it reasonable that if I were actually doing a stock selection guide of my own, I don't mind the 20% estimate. This is an exciting small company. Nick Strategos has already told us how they plan to grow and how they're managing the business. Everything I see about the company tells me that the net margins are achievable in that 10% range. I made one change. I said, well, what if? What if the number, and this is a sensitivity analysis, what if the number were closer to 24 instead of 34? I can sink my teeth into that. I think maybe that's a little bit low, but again, it starts to approach that number. So again, in terms of a potential audit or a sanity check, whatever you want to call it, this makes sense to me. That, maybe take a step back and say, well, maybe that 34 is a little bit ambitious, and maybe something in between makes sense. The point being, again, as we're going to point out in one of the concluding slides, the evidence is that the projected returns, the annualized returns, approach those return on capital levels at some point down the road. Anything you would like to add to that, Ken?
Yeah, I'm wondering, Mark, if we couldn't also characterize this as what would Five Below look like, which is a pretty good momentum play right now. It's really been moving pretty well, although not as dramatically as it was maybe 8 or 10 months ago, but it's still really richly valued. What if it disappointed and the momentum went away? What would be a more useful PE value over the long run? And I'm certainly much more comfortable with a stock with a PE of 24 or even 22, which takes that projected annual return, the par value, down to under 12. If I went to 22 on that PE ratio, I would say that I'm coming darn close to that 9% return on capital. And maybe what I'm looking at when I'm looking at return on capital is a non-emotional, non-momentum driven par value, which I can use to kind of check myself when I'm getting a little bit too enthusiastic on my numbers coming from the analyst community.
Could be. It's just it's food for thought. It's decent fodder. All right, and the other area that I wanted to mention here tonight, and some of you are very familiar with this, every week we put out what we call the Fave 5, where we basically screen for, again, vetted companies, generally very high quality, excellent companies, and then we subject them to a secondary screen. One of those secondary screens that we have used over the last year has been this owner return on capital. There's actually been fairly few selections, but they're knocking it out of the park. So again, what this is suggesting to me is obviously we're looking at the ones up at the top here, some of the Hugh McManus stuff, paying close attention because these numbers are not to be trifled. If we can hang on to those and maintain anything like those over the long term, it's frankly exciting. And the most oversold, that's a technical indicator, doing very well. When a company gets oversold according to the relative strength index, that's something, if you're in an investment club, you want to understand it. Whether you use it or not, that's completely up to you. But I do find comfort in finding a stock that meets all my criteria that happens to be oversold. Very much like Hugh and his Irish Spring Index of watching for companies that are vetted, that are excellent companies with good-looking potential futures that are trading near their 52-week lows. Same thing, and he's got a pretty good track record there. Launchpad, again, one of our favorites this time of the year to watch for companies with exploding earnings expectations for the next year. And
I like to use this chart in a slightly different way too, Mark. I like to use it to just kind of drive home the idea that while the numbers that come from analysts many times are good solid numbers for us to use as a basis, as a beginning of our analysis, many times the recommendations that come from those same analysts, the buy, hold, sell kind of things, maybe they're not to be trusted nearly as much. I noticed that the numbers that are based on buy, hold, sell from S&P, from Morningstar, even the ACE numbers, I noticed that they're not doing nearly as well compared to the general market as some of the other metrics that we're using. In fact, 4 of the 5 that are in red really tend to be analyst driven as far as recommendations are concerned.
I'm going to stay off that soapbox just in case any of my professional colleagues are listening.
Are listening to you, okay.
Oh, that's a soapbox for another day because you know how deep I can go into that subject. All right, so here are some of those results, and here's kind of the answer to one of the questions that we had earlier. Here are some screening results. These are companies with excellent quality, top quintile. So it'll be companies above 80 when it comes to their quality. You can see the projected annual returns, but then you also see this return on owner's capital, on the far right-hand side. I did leave the financials in this one. So Charles Schwab actually made the list. That's a return on equity number for an asset-based company. That and Greene County Bank Corp. So they have a different calculation. The reason being, and Greenblatt won't even touch the financials because of it. It's just a quagmire of deciding, how to handle the debt and all the stuff that goes into it. He basically just won't do his magic formula on the banks, and in fact, he won't even do it on small companies. But that's his reason for doing it. But again, Charles Schwab does make this list on a par, a quality, and a return on capital listing. So what does one of them look like? This one happens to be the one up at the top of the list. It's also suggestive of an audit situation. This happens to be a electronics device / automotive stuff component supplier in the domestic Chinese market. So that probably tells you a lot about what's been going on in the last couple of years. And the situation that you see here is this is a company that has a projected annual return in the mid-teens, the 15.8 that I've got highlighted in the middle. And if you actually do the calculation, the return on owner's capital is again the largest one on that list. In order for that to be a legitimate situation, their cash on hand, which who knows, it's a Chinese company, and you have to wonder if you can trust the numbers. They've got a huge cash hoard that basically amounts to $6 a share. So with the company trading at $6, again, you take away that $6, and it has a whole lot of impact on that return on owner's capital. It'd be one that we might want to watch a little bit closer. They've got a little bit of debt, not a whole lot. But again, what kind of jumps off the page at me is, might this be a situation where doomsday or Armageddon is part of the analyst expectations, especially when it comes to the PE ratio that you see over here. Certainly the trend has not been favorable, but this 10 that you see here maybe is a little bit more punishment than they deserve. If the tariffs or whatever come off and business improves, if these numbers actually come true, who knows? Could be opportunity. I would certainly classify it as speculation. But just to show you the type of screening company that can, fall out of the results on a screen based on return on capital.
Well, and Mark, to complete the whole thought from the last 8 or 10 slides, if the par is much larger than the return on capital, then we suggested that the PE might be aggressive, might be quite aggressive. When we were looking at Five Below, we might complete the thought by saying if the par is a lot smaller than the return on capital as it is here, then perhaps we're looking at a PE that's not aggressive enough, that's too conservative. And in either direction, that's bad for an SSG, and maybe this begins to give us a tool where we can work these out so that we don't have these large discrepancies between being extremely aggressive and being way too conservative, but we can stay in the more realistic range, and that would give us a better call as to what we're going to do. And that helps us manage the portfolio if we can bring our par values in line with reality. That gives us a little better tool to manage with then.
Absolutely. Again, it's kind of an embedded audit situation, and just something to watch for as we do these studies as part of our roundtables and everything else, the screening results. So again, just to reinforce, we're talking about return on owner's capital, using a projected pre-tax income, just like we've always done it on stock selection guides for the last 80 years. It's no different. The beauty of it is it avoids some of the accounting mysteries of using bottom line earnings. Probably one of the reasons that George Nicholson and his colleagues put Section 2A on the front and not earnings. And again, fairly straightforward when it comes to this stuff. And again, as Charlie and Joel point out, probably not prudent to really ignore it over the long term, that the average annualized return tend to approach the business's return on capital, all the way back to our restaurant and our residence situation. All right, and with that, I'll just leave, again, this is one that we have been talking about for several months, but one of the reasons that we're looking at this and listening to this is because of Mr. Greenblatt's achievements. Over a span of 20 years, he ran a hedge fund, which actually turned $1,000 into $840,000. That's 40% per year, folks. And over that same time frame, putting that money into an index fund, tracking the S&P 500 would have, going from $1,000 to $12,000 is nice, but it's not 840. And I really think that this concept, this slide, captures what the National Association of Investors is all about, because we believe it's possible to get between those two numbers. In every small bit, every incremental thing that you do, much like what we do with the Mid-Michigan chapter and Manifest Investing, with the types of things that we pursue and the avenues we go down, it's really intended to get between those two numbers. And I just love his confession there. There are people that have confronted me on that slide that I think they need to really think about that statement in orange. Because everybody that comes to this community, there are no guarantees, but the possibilities are really pretty powerful. And there are so many people, many of you sitting in the audience here tonight, that are between those two numbers and smiling. So with that, we do have a bibliography, but here are some of the places we're going to be. Ken, would you want to give a quick rundown on some of our, you called it gravitas? Is that like gallivanting?
I think we're going to gallivant around the country. Quite a few new places this year. We haven't been to St. Louis for many, many years. You and I together have never been in Philadelphia or New Orleans. I'm going to follow your visit to Columbia, South Carolina last year with a visit myself this year. We're both going to be at the National Convention in Dallas. Mark's going to be in Sacramento, and then our roundtable program, as usual, is going to be coming up. We're going to try to stick to the last Tuesday of the month as closely as we can. We'd love to see a lot of you there. And with that, I'm going to try to deal with some of these hands in the air while you get a chance to look at our bibliography. Again, if you'd like these slides, just drop an email to mark@manifestinvesting.com, and he'll be glad to send those slides to you. Meanwhile, Debbie, you've been very patient with your hand in the air, so I'm going to unmute you. Go ahead, Debbie. Debbie Duncan, go ahead. I'm going to assume that's an inadvertent hand, and I'm going to take it down, and I'm going to move to the questions now, and let's see if we can cover some of these questions. If I can get them on the screen here, we're going to do it. Okay. Well, we're getting a lot of, you've given me a lot of things to talk about. Marie wants to know, Mark, are there plans to add any of these numbers to the Manifest Investing database?
They're already in the database. We use it for, some of our screening stuff that we do now. And I think what Marie really wants to know is, are you going to put them at her fingertips? We will be working on that. We're going to be doing some general revisions to the stuff. Certainly not messing with any of the foundational core concepts, but I can see where people might want to screen on this topic, screen on the triple play. There are some things that we're going to be doing.
Okay. I'm moving through these things. We've gotten a lot of nice comments, Mark. We have two people that seem to have problems with the presentation itself, and the kind of problems that you're talking to me in the question box, Linda and Ann both, those problems seem to be the kind of problems people have with GoToMeeting when they're working on a wireless system, many times a Wi-Fi system, where there are other people using the same system and doing some heavy-duty streaming, either watching movies or playing an intense video game of some sort. I would urge you, if you're coming to a webinar, to either kind of get the other folks in your particular Wi-Fi spot to stay off the Wi-Fi if you're going to use a wireless, or to plug a hard wire into your router and plug it into your computer and use a hard wire. You'll avoid many of the audio issues, and you'll avoid a lot of the problems with lag that you have if you're using a Wi-Fi that's being used a great deal by another person at the same time, okay? I'm looking at the questions. I think that for the most part, we've covered them all, Mark, and we'd like to wish back all of you that are wishing us happy holidays, Merry Christmas, and everything else. We'd like to wish that right back to you. We'll be back together with you. I think that our December roundtable will actually be in January, on the 7th of January.
That's correct.
And that's because the last two Tuesdays in December are Christmas Eve and New Year's Eve. And Mark, we're not going to go and have to worry about doing this program on either of those days, okay? So Merry Christmas to both Lynn's.
I still think the adult beverages on New Year's Eve and stock picking, how dangerous could that be?
Well, I'm not going to sit here. I'll tell you that right now. Okay. So with all of that, I was very impressed and pleased with the size of the audience. I thought we would have a much smaller audience for this topic. So it looks like we've struck a nerve with some people. We're giving people a little bit to think about, and we'll come back to you with some of our further thoughts on this topic maybe in another 4 or 5 months. If you have something you'd like us to talk about on one of these topics programs, drop me a line, drop Mark a line, and we'll try to pull a program together for it. Merry Christmas, everybody. Happy New Year. Mark, the same to you. I know we'll be talking a lot before that happens. So with all that, thanks for coming this evening, folks, and I'm going to shut the webinar down. Bye-bye.
Thanks so much. Merry Christmas, everybody.